Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Jason Heath. Now, many of us are dreaming up a New Year's resolution with the turn of the calendar just around the corner. But it's also a great time for investors to take a moment to reimagine their investment portfolios too. The year-end offers a great opportunity to fine-tune our financial goals and investment strategies, and the potential to squeeze out the gift of tax savings too. So, on that cheery note, let's hear 5 tips to help us better position our portfolios before the end of the year from a seasoned financial planner who's brimming with ideas. Joining us here today, Jason Heath. He's a repeat guest. He's the founder of Objective Financial Partners. Jason, great to have you back with us on the show. We appreciate you taking the time.
It's great to be back. Thank you, Jason.
I know lots of year-end. We'll talk lots of year-end financial stuff, but are you prepared for the festivities for the rest of the year? Or do you have lots of that to take care of as well?
Yeah, look, I think that one thing I will say, it's a very busy time of the year for sure. We run a pretty busy advice-only financial planning practice that's busy most of the year, except for over the summer when nobody wants to talk about finances. But this time of year, there's lots of sort of year-end specific things, whether it's income planning or contributions to or withdrawals from certain accounts. But I do find a lot of the busyness actually relates to people wanting to clear things off of their plate before the end of the year. It's not necessarily year-end specific, and I think a lot of it's just trying to get the new year started right. But there's definitely some very specific year-end stuff, and glad to talk about those things today.
Yeah, that's actually some of the best advice that I've gotten. Just part of the benefit of being involved in these conversations on the Inside Investing is I get to learn along with our audience. And one of our investors, which we've got the link actually to the webinar with Nicole Ewing on the resources section on the left-hand side, talking around how tax planning and kind of investment strategies shouldn't be just kind of a once a year type of activity. If you're able to kind of handle it in bite-sized chunks throughout the year, it actually makes things easier and can make for better personal performance.
100%.
So you talked about how it's a busy time of year, but how is your team dealing with how crazy it is for you guys now? Do you guys manage to keep your head above water?
Yeah, it's tricky because there's a lot of year-end conversations you want to have with people that the closer to year-end maybe the better, but it's tough to do. There's only so many conversations you can have the last couple of weeks of December. So we try to get certain conversations started earlier in November. We try to have certain conversations over the course of the year. I think you alluded to it, Jason. Tax planning and just financial planning generally should be a year-round affair. And I think it's one of the big drawbacks of the way that tax work is done in Canada. Most advice that people get as it relates to their taxes isn't really advice. It's submitting their taxes in April. It's getting their taxes done. It's retroactive. It's dealing with what has already happened as opposed to proactive in dealing with what is yet to happen. And year-end, I think, offers a good opportunity for investors and just taxpayers generally to sort of review their goals and think about what's next.
All right, so on that topic of kind of goals and financial plans, why is year-end kind of generally considered to be a good time to kind of rehash kind of how things have gone and think about changes to your investment portfolio?
Well, I think it depends on the type of investor you are. It depends on the income sources that you have. But I think at the end of the year, it's an opportunity to look at things like tax loss selling, for example, realizing capital losses on purpose, capital gains planning. Sometimes it can make sense to realize capital gains on purpose. And it's a lot easier to do that towards the end of the year when your income for the year is mostly known and there's unlikely to be more capital gains and losses between the time that you're doing things and the end of the year. Same with RSPs and RIF accounts. Someone who's got a tax sheltered registered account, whether you're 71 and you're converting your RSP to a RIF, or you're well before that age and you're potentially considering early withdrawals from your RSP, I find it's best towards the end of the year when you know what your income is. There's a lot of year-end planning for incorporated professionals related to year-end bonuses and declaration of dividends. Taxpayers who pay quarterly income tax installments, there's a lot of planning towards the end of the year to determine if they should pay their December 15th payment. There's some contributions like our ESP, Registered Education Savings Plan, and now the new FHSA, First Home Savings Account, that don't get the extra 60 days after the end of the year, like RSP contributions. So I think it's a common time to do year-end investment and tax planning, Jason.
All right, that's all great information. And just a quick note to the audience as well. We've got some really engaging interview lined up here with Jason. But if you'd like to get your questions in so you can pick his brain later on in the show, please go ahead and get your questions into our question and answer box on the screen. As well, to our viewers tuning in on our YouTube live streams, hello to everybody out there. Please, if you'd like to engage with our console or get your questions, you can see the link in the pinned in the comment section below. Pop in there and we'll be happy to tackle that from going forward. Okay. All right, so let's get into our conversation. We've got some tips we want to get to, so let's talk about how we can better position our portfolio for the new year. All right, so we've got 5 to get through. Your first tip for investors ahead of the new year is to optimize their asset allocation across their portfolios, or in other words, hold investments in the most tax advantageous accounts. Why can that be so impactful to returns over a long period of time?
So first off, just a quick clarification, I guess. Asset allocation, most people are familiar with that. It's how much you've got in stocks and bonds. It's how much you've got in tech stocks versus financial stocks, for example. Asset location is about determining which assets you should hold in which accounts. And I think it can be important just because different types of investments are taxed differently. And taxes can have a drag on your return over time. If you can reduce or just outright avoid certain taxes, it can be possible to boost your returns. And I think that, if you look at studies, there's good studies out there by Morningstar and PWL, for example, that suggest that tax efficiency can improve your returns by something like 0.25%. But on a case-by-case basis, if you crunch the numbers, it can be a lot more, it can be less. If all your money is in an RSP, it may not matter as much because tax implications are fairly minimal. And some people might say, oh, geez, 0.25%, is that really going to make or break my portfolio's return? But I think if you're working with an advisor, for example, if it helps them earn their keep, or if you're self-directed, and certainly a lot of the people that are listening in today are self-directed investors, if you've already sort of mastered investing 101, this is an investing 201 concept. How do I pay less tax on the different types of investment income?
Yeah, right. It's trying to be efficient, right? We all work hard for our money. Like nothing in the market is free. So kind of trying to keep your hands on some of those gains and income is really going to be the name of the game. And thanks for you caught me in what might be a kind of bit of a common slip of the tongue. I said asset allocation, but asset location is kind of what we were talking about. So that's going to be another term that those out in the audience are really going to become familiar with through the next few minutes here. All right, so give us some examples of investments that might make some sense in different accounts versus others.
So I guess first off, bear with me. This is sort of a technical answer, but the most tax efficient investments to hold in your RRSP, for example, are interest-bearing investments like bonds, GICs, savings accounts. Interest-bearing investments, if you own them in a taxable investment account, they're not very tax efficient. Interest is fully taxable income, just like employment income, for example, which is taxed at your marginal tax rate. If you hold those types of investments that pay interest in your RSP, it can be a way to defer tax. US and foreign dividends are also taxed at that same high rate, fully taxable at regular income rates. One distinction with US and foreign dividends, though, if you own them in your RSP, which may be a good place to have them because of the high tax that's payable, they will have withholding tax, or they may have withholding tax that is scooped right off the top of the dividends. Foreign stocks are typically subject to 15 to 25% withholding tax, kind of depends on the country. But US stocks held in your RSP, there's no withholding tax on the dividends. So US stocks can be a good investment to hold in your RSP. In a taxable account, a non-registered account, capital gains are only 50% taxable. Most of the time, there is this new capital gains inclusion rate that's sort of lingering in the background, but it generally doesn't apply to most taxpayers, you'd have to have a capital gain of over $250,000. Discussion maybe for another day. But stocks can be really tax efficient in a taxable account because capital gains are only 50% taxable. Canadian dividends are taxable at a lower tax rate than US or foreign dividends in a taxable account. So they're a really efficient type of stock to own in a taxable account. I think I would avoid focusing on Canadian stocks to the detriment of other stocks because the Canadian stock market is not very well diversified, but Canadian dividends do get special tax treatment, a little bit lower tax rate than foreign dividends. Some investments pay a return of capital, not very common, it's tax-free. It increases your future capital gain. It's a tax-free return of your original investment that lowers your cost base. And TFSAs, it kind of depends. Interest in Canadian dividends, capital gains are all tax-free. US and foreign dividends have between 15 and 25% withholding tax. And with your TFSA, I think I'd be less inclined to focus on the tax efficiency and base it in part on your time horizon. If you've got a long time horizon, stocks work great. If you've got a short time horizon, your TFSA is meant for something that's short-term in nature, I might bias towards fixed income.
Yeah, I think that's a nice kind of point you make there. Is there's really no one size fits all kind of plan for everybody. It's all about kind of risk tolerance is one big thing to keep in mind, but then time horizons, it's another. And kind of one question I was going to ask, but you happen to answer that at the end, was around dividends that folks. It was a common question we get from self-directed investors around it being taxed on U.S. dividends, but you cover that in TFSAs because they don't get the same tax treatment that your RRSPs.
Our RRSP gets the special treatment, not TFSAs. So.
Yeah, you got that right. So all right, so let's keep pulling on that thread. So now asset allocation isn't purely academic, an academic exercise. What are some of the reasons why an investor might choose not to hold some investments in the most tax efficient account?
I think simplicity is probably the main one. So say you have a mutual fund or an all-in-one exchange traded fund that you want to hold across all of your accounts. That might be one reason, just to keep your investing simple, even though you might be foregoing some tax efficiency. Time horizon, as I alluded to, if you've got a short time horizon and you need money for a down payment, for example, you might hold fixed income in your taxable account, even though stocks earning capital gains might be more efficient. And that same person who's saving up for a home down payment might have their RSP invested really aggressively into stocks, even though fixed income is more tax efficient potentially in an RSP. So sometimes you can end up in a situation where your tax efficiency is somewhat backwards, but I think the risk tolerance, time horizon, those are considerations that I would start with. And tax is important, but I think it's something you consider as a second or a third consideration.
Yeah, good point. And I think ultimately, at the end of the day, if you're paying tax, we certainly want to minimize that. But if you're paying tax, typically that means you're making money, at least from a capital gain perspective. So at least you're coming out ahead in that regard.
For sure.
And just a quick note to our viewers, Jason actually goes into more about how to optimize asset allocation in more detail in his past episode with us. It's called 5 Tips for Building a Tax-Efficient Investment Portfolio. And you can find that link on the resources section on our broadcast platform, as well as on TD's YouTube channel and in the Learning Center on Webroker. All right, so on to our second tip to help better position a portfolio with the year-end in sight. Now, you could intentionally consider triggering some capital gains from a non-registered account before year-end. How could this potentially be a savvy tax move for investors thinking about kind of the larger picture?
Yeah, so this is a consideration that I find is a little bit controversial, along with early RSP withdrawals, which I think we might touch on a little bit today. So to be clear, this is for investors with non-registered investments, taxable investment accounts where selling for a profit results in a capital gain. I'd say intentionally triggering capital gains can sometimes make sense to do. As an example, I met with a client earlier today who has a family trust, and without getting too technical, it's an account with stocks for his university-aged children. And each year we intentionally trigger capital gains in order to have capital gains taxed at their low tax rates while they're going to school, before they're working. And I think the same would apply to other investors. If you've got a low income year and you're going to need to sell an investment in the future, you're going to need to take a withdrawal, or you just know eventually you're going to be in a much higher tax bracket, there can be an advantage to intentionally triggering a capital gain. Even if you sell that investment and repurchase it, if it's an investment you still want to hold, you don't need to sell it and get rid of it. So I think it's something to look at strategically that may apply in some instances. Donating securities with deferred capital gains is also a great way to do things, because you avoid the capital gains tax, but you get a charitable donation receipt. I wouldn't do it for $50, but if you're doing it for larger amounts, it could be certainly well worth it. And I think it's just a good time towards the end of the year to review your asset allocation. Sometimes, particularly this year, it's been a great year for stocks. You may be overweight stocks because you've had a run up in the markets. You may be overweight a specific stock because it's done exceptionally well. And if you're likely to sell for investment purposes, it might be important to decide whether it's good to do this year or next year, potentially depending on income differential.
And this isn't like a stick your head in the sand type of strategy. This is something that you've crafted likely with your either investment planning professional or a tax professional to help kind of maximize things for the longer term. It's not a kind of a seat of your pants type of decision.
For sure. Yeah.
All right. Now, one thing that can help minimize an investor's tax bill is kind of the opposite, kind of what we were just talking about. And this might be some tax loss selling. Can you explain how that works and why doing it before the year end makes sense for some investors?
Yeah, not as common this year, which I guess is a good thing for most investors. Stocks have done so well, but tax loss selling is when an investor sells an investment at a loss intentionally. It's a tax motivated transaction as opposed to just selling based on the investment merits of the investment. And so when you trigger a capital loss, when you sell an investment for less than what you purchased it for, you can save tax because it gives you a tax deduction. It's not a tax deduction that you can claim against other sources of income, like if you make an RSP contribution, for example. A capital loss can be claimed against a capital gain. So this is, again, specifically for non-registered taxable investment accounts. And sometimes people will engage in tax loss selling towards the end of the year, in particular, when they've got large capital gains that they've incurred on other investments that they want to offset. They want to reduce their total capital gains across all their investment accounts for the year. So say somebody's got a $20,000 capital gain so far in 2024. Generally speaking, half of that capital gain, or $10,000, would be taxable on their tax return. Tax payable might range from 20 to 50%, depending on their other sources of income, what province they're in. So they might have another investment trading at a loss that they can sell to reduce that capital gain and pay less tax as a result, and that is tax loss selling.
And maybe to further clarify the situation for the audience, what if someone sells an investment, let's say in their RRSP that they have a loss on? How would that have any impact on tax loss selling?
Great question. And I do find sometimes people will ask about selling an investment in their TFSA or their RSP. Capital gains and capital losses in TFSA or RSP accounts do not matter for tax purposes, at least not directly. You don't report it on your tax return in the year that you incur it. TFSAs are always tax-free once the money gets in there, whether you sell, whether you withdraw, whatever you do. RSPs, you're really only paying tax on a withdrawal. So selling an investment for a profit or a loss in an RSP or a TFSA has no impact. This is just like non-registered investment accounts, corporate investment accounts, taxable investment accounts.
All right, thanks for clarifying that. Now, you caution investors from reflexively claiming capital losses in the same tax year. Why are we making that caution?
Yeah, so if you've got a current year capital loss, maybe just to clarify one thing, if you sell an investment for a capital loss and you've got other capital gains for the year, you can't decide not to claim that capital loss. So what we're talking about here is if you have a net capital loss for the year, you've got more capital losses in total consolidated than you do capital gains. And if you've got more losses than gains in a current year, you can either choose to carry those losses back up to 3 years, or you can carry them forward into the future to claim against capital gains. So if you had capital gains back in 2021, for example, and you've got capital losses this year, you can carry those losses back to 2021 and get a tax refund now after the fact. And it's a bit of a fine balance, because if your 2021 income in this example was relatively low, but you had a capital gain, you may or may not want to carry a loss back to that year. It's tough because this is the last year you can carry a loss back to that 2021 capital gain, because you've got that 3-year window. But if you paid a relatively low rate of tax, you may want to save that loss. You may have a capital gain in the next couple of years at a higher tax bracket. And if your tax bracket could be 10% or 20% higher in a year or two compared to 2021, you might earn a 10 or a 20% after-tax rate of return effectively by waiting to claim that capital loss. So tax refunds are good, but I prefer bigger tax refunds over smaller tax refunds. Think twice before just instinctively claiming a capital loss.
Yeah, that's one of the things. You don't want to be kind of like forced into using it because you think you're going to lose it, whereas it might be a bigger advantage for you to kind of forward date those losses. Yeah, that's great food for thought. Now, one thing that investors they need to watch out for, and this is a term, it's called a superficial loss. It's a rule when you're tax loss selling. How does that work, and how can investors take steps to avoid it?
So just to explain a superficial loss, the most common situation where it will happen is when an investor sells an investment at a loss. They sell it for less than what they purchased it for in a taxable investment account, and then they buy that same security within 30 days of the sale. So say somebody sold an investment because they wanted to claim the loss, but they didn't want to sell the stock. They immediately bought it back. That's considered a superficial loss, and the loss is not tax deductible. It's as if you never incurred the loss in the first place. Technically, though, it also applies to the 30 days prior. So it's the 30 days before or after the sale if you purchased that investment, or if your spouse or a corporation or a trust that you control. So it gets really sort of technical, but basically you, your spouse, or an entity that you control cannot have purchased that investment within 30 days before or after. Otherwise, that superficial loss is denied. So sometimes what people will do is they might sell an investment at a loss, and they'll sell an ETF, and then they'll buy a similar ETF, but not the identical holding. Or they'll sell a bank and they'll buy another bank or something like that. So you're staying more or less invested in the same security, and you might wait 30 days and switch back to the other one that you really wanted to own, for example. But one thing I should mention, there's also a neat way to take advantage of the superficial loss rule to transfer losses to your spouse. So if one spouse has losses that the other spouse actually kind of wants on their tax return, if you sell an investment and then your spouse repurchases it within 30 days, your loss is denied, and then their cost is reset to your original cost. And then if they wait another 30 days, they can sell and claim the loss. So it's a way to effectively transfer capital losses from one spouse to the other. And it might come in handy if one spouse has gains, the other has losses, or if you want to move losses from a higher income spouse to or from a lower income spouse rather to a higher income spouse. But you need 30 days before the end of the year to do this. And it's something you can do any time of the year, really.
That's a very interesting way to look at that. So now, in terms of the 30-day calendar, does that start after the trade date, or is the trade date included in the 30 days?
Before and after the trade date. So you've got basically a 60-day window that, again, this time of year, if an investor is trying to trigger a loss before the end of the year, probably the best thing to do if you want to stay invested is, again, sell and repurchase a similar security.
All right. Once again, more interesting food for thought. Okay, so let's move on to the third tip. And this is for parents all out there in the audience. It's to maximize annual contributions. And this is to a relatively new product, the First Home Savings Account, or FHSA. That's a bit of a mouthful to say, but before the end of the year, even if your child doesn't intend to buy a home in the near future. What's the upshot to this strategy here?
So a little background, FHSA, it's for anyone between the age of 18 and 71 who has not owned a home in the previous 4 years. You can contribute $8,000 annually, that's the annual maximum, and $40,000 during your lifetime. Contributions are tax deductible, kind of like an RSP. The money grows tax-free, kind of like a TFSA. And then you can pull money out to buy a home within the next 15 years. So I think one consideration is if you have a child or a grandchild for that matter, and you intend to help them to buy a home in the future. One strategy to consider, if you've got non-registered investments that are earning taxable investment income as it is, and again, you're planning to gift them money anyways, you could give them money to contribute to an FHSA. It gets that taxable investment income off your tax return. It gives them a tax deduction. It allows the money to grow tax-free. The flip side is that it does result in you giving money to a child or grandchild that you can no longer control. It, potentially could be a lot of money depending on how much you intend to gift at a relatively young age. So I think you need to balance how much you're giving and who you're giving it to and responsibility of the child. But if you think that you're going to have a child who or grandchild who will buy a home in the next 5 years, again, maximizing this account would be $8,000 contributions over 5 years. So if somebody's within 5 years of purchasing their first home potentially, they might want to consider opening an FHSA before the end of the year.
Now, speaking for the gifter in this particular case, let's say they've got capital gains on those investments. Now, mind you, caveat, everybody will need to review their own scenario with their tax professional, but how would those gains that you have, what's kind of a rule of thumb of how those could be treated from a
good question. The tax deduction on the FHSA, the account is owned by the child or grandchild, so the tax deduction goes to the child or grandchild. So in that case, it wouldn't help the parent or grandparent triggering a capital gain. It would, could result in some tax if you're selling an investment to make a gift.
Okay, all right, that's important clarification to make. So let's say an investor doesn't have, maybe an additional $8,000 laying around, but they still want to contribute to an FHSA. What do you think about the idea of withdrawing from a TFSA to contribute to the FHSA?
Yeah, I think it's a good idea. You can withdraw from a TFSA tax-free. There's no tax implications of anything really to do with a TFSA. And then you can get a tax refund contributing to the FHSA. And ideally, you then take the tax refund and reinvest it back into the TFSA or the FHSA and do something smart with it. But I think it makes sense to do before the end of the year. Again, if you anticipate somebody buying a home in the next 5 years. But I think that's the neat thing about a TFSA. You can multiply your TFSA savings by using it for other tax deductible accounts like FHSAs and RSPs. So great opportunity, in my opinion.
And correct me if I'm wrong here, unlike an RRSP, your TFSA, any withdrawals that you make throughout the year actually get returned back to your contribution room the following calendar year. Am I right on that?
100%, yeah. So any money you take out of a TFSA the following January 1st gets added to your TFSA room as well as any additional room for the subsequent year. So it's not like it's you use it and you lose it. You use it and you gain it back, and potentially you do something better with it in the interim, particularly if you think you may be buying a home within the next few years.
All right, quick programming note for our audience. You can hear more about tips for making the most out of FHSA accounts in our episode, which is tough acronym once again, FHSA tips to help buy a home with financial planner Ryan Lee. There's a link in our resources section on this broadcast, as well as on TD's YouTube page, and also, as you'd expect, in our Learning Center on Webroker. All right, now, speaking of contributions to a registered plan, your fourth tip is to contribute to a registered education savings account. So more acronyms, RESP, before the end of the year, especially if your child is older and you aren't on pace to maximize the government's grant money. Why is time of the essence here?
So RESPs are great accounts. They attract free money in the form of matching contributions from the government to save for post-secondary education for a child, for a grandchild. Typically 20% on up to $2,500 of annual contributions, but you can't actually catch up on up to $2,500 of missed contributions. So you could make a $5,000 contribution and get a $1,000 government grant. One thing that I find people are sometimes confused about, RESP accounts do not give you a tax deduction like an RRSP. But what happens is the withdrawals are, the money grows tax deferred, and then the withdrawals are partially taxable. I say partially because the original contributions can come out tax-free, but the government grants and the growth are taxable to the child or the grandchild, which generally they pay very little or no tax because they're taking the money out when their income is low, and they get tax credits they can claim for their tuition as well. And I think if you're in the home stretch, you've got a child who's entering high school in particular, and you're planning to help them out with their education. If you haven't maxed out your RESP contributions for the year or for previous years, there's an opportunity before December 31st to contribute. And again, up to $5,000 can get you the 20% grant for this year, and up to 20% for a previous year as well. I think one key is, don't compromise your retirement for your kids. But if you're going to be paying for it anyways, take advantage and try to get use of some of that government money.
Your kids might come at us from it with a different perspective. They want to make sure we maximize their education over our retirement. But yeah, they got to be able to strike a nice balance there. Now, also just a quick note to the audience: here at TD Direct Investing, we offer what are called family plans when we're talking about RESPs. These are where you have multiple beneficiaries all in one account, so it saves you having to manage multiple accounts, makes it easy to take care of, and through your you can make contributions together and helping you maximize those grants that you're getting back from the government. So take a look into that if that applies to your situation. All right, so we talked about this from the perspective of an FHSA. Do you think it might make sense to withdraw money from a TFSA to catch up on an RESP contribution?
Yeah, I think the logic is the same. You're taking a tax-free withdrawal from the TFSA. You're contributing to the RESP. You're hopefully getting that 20% government grant. So you can turn $100 in your TFSA into $120 in an RESP once you add in that government grant. And although, as I mentioned, a part of your RESP withdrawal is taxable, unlike a TFSA, which is always tax-free, generally speaking, very few children and grandchildren actually pay tax on RESP withdrawals. And the same concept, frankly, applies with RRSP contributions. Taking a TFSA withdrawal to contribute to your registered retirement savings plan is another good way to magnify your savings by the tax refund that you can get from an RSP contribution. So TFSAs are great, but sometimes I find there are other tax preferred accounts and opportunities that you can put that money to better use.
All right, so we're going to move on to your fifth tip here. It's our last tip, but it's certainly not the least tip. This one's focused around year-end for the retirees out there, and that's to consider early withdrawals from your RRSP or withdrawing more than the minimum amount required from your RIF. At first blush, this means they'll be triggering some taxes maybe earlier than is necessary than they might need to. Why might this be a savvy thing to do?
So this is another controversial one, but I think it's important to remember that our RRSP is a tax-deferred account. It's not a tax-free account. Those withdrawals are taxable. Right. You save money when you contribute, you pay tax when you withdraw, and you have to take money out by no later than age 72. There's minimum withdrawals that you need to take once you convert your RRSP to a RIF, a Registered Retirement Income Fund. And if your RSP grows really large, those minimum withdrawals that you're forced to take can push you up into a higher tax bracket. They could result in loss of government benefits or reduction in government benefits, particularly old age security. And it can cause an RSP to backfire. That's maybe too strong a word, but if somebody's in a higher tax bracket in retirement than during their working years, it can be disadvantageous, let's say. And a large RSP or RIF at death could also result in a massive amount of tax as well. So I think early RSP withdrawals can make sense, particularly if you retire at a relatively young age. If somebody retires in their 50s or 60s and you don't have to take money out until you're 72, it could be an opportunity to take advantage of your low tax brackets for a number of years by taking modest intentional RSP withdrawals. And it can work very well along with a strategy of deferring government pensions like CPP and old age security, and trying to maximize those benefits as well, and spend down your RSP in the early years and defer government pensions, which frankly are a lot easier income to deal with in your 70s and 80s, particularly if you're self-directed. If you're self-directed, drawing down your RRSP early can enable you to do more of your investment management when you're younger, and cognitive abilities might be better than having to deal with it in your 70s and 80s by deferring government pensions. So that's a long way to say, consider early RSP withdrawals, focus on minimizing lifetime tax, even if you're intentionally paying a little bit of tax today.
Okay, so you alluded to some penalties that might come along with this type of strategy when we're taking money out of our RRSP. What should investors keep in mind when they're considering these sorts of withdrawals to help reduce their tax bill?
Yeah, so I don't know if penalty is maybe too strong a word, but I suppose you're penalized by having to pay the tax. I think it's one thing to clarify is that you don't necessarily pay a penalty by taking an early RSP withdrawal. You pay tax for sure, and it's tough because we've been told, we tend to be told, defer tax at all costs, max out your RSPs. Taxes are bad. And again, I'm more inclined to try to minimize lifetime tax, and sometimes that means using up low tax brackets early in retirement. And as it relates to tax and RSP withdrawals, if you take a lump sum withdrawal from an RSP, the first $5,000 is taxable at 10%, it isn't taxable, there's withholding tax of 10%. Between $5,000 and $15,000, there's 20% withholding tax. And then if you take a withdrawal of more than $15,000, there's 30% withholding tax. It's a little bit different in Quebec, but similar outcome. And then you may owe more tax when you file your tax return than what was already withheld. You may get a tax refund if the tax withheld was too high. It kind of depends on your income and deductions and credits. And one other minor thing, if you convert your RSP to a RIF and you take the minimum withdrawal from your RIF, there's no required withholding tax. And sometimes people think that means that their RIF withdrawal is tax-free, and it isn't the case. Even if you can avoid the withholding tax, it's still taxable income. And I think the goal for most retirees should be to try to smooth their income during their lifetime, pay the least amount of lifetime tax. Some taxpayers, some retirees should definitely defer their RSP withdrawals till 72, but I think the average retiree should probably at least consider some early withdrawals. I think it's just really important to try to look at this as early as possible ahead of retirement, or certainly into retirement, so you can keep more of your investments on an after-tax basis.
All right, now before we continue, I've got a quick question for our viewers. Are you enjoying the show so far? Well, then you can make sure to subscribe to the TD Direct Investing YouTube channel. And if there's a topic you'd like to learn more about, let us know in the comments. Plus, you can follow us on Instagram. It's at TD_Direct Investing to get a sneak peek at upcoming shows and have a ton of other content designed to help build your investment knowledge. All right, we've heard a lot of interesting perspectives on our program in the past, so I've got a couple clips primed up and ready to bounce some of those ideas off of you to see if you disagree, and if so, why. All right, so our first idea comes to us from financial planner Talbot Stevens from Financial Success Strategies. He suggests using an RRSP gross-up loan to supercharge retirement savings during tax season. So go ahead and roll the clip.
So the investor has $1,000 in their pocket, late RRSP season, they go out and borrow another $1,000. they put that $2,000 combined into the RSP, right? They'll get a refund back of half of the $2,000, $1,000, right? And if they do that quickly, now these days you can get your taxes filed and refund back in a couple of weeks. They'll get that refund back, and it's enough to completely and almost immediately repay the $1,000 gross up loan, right? So now we truly have the $2,000 in our RSP, which equates to $1,000 after tax that we started with.
All right, so Jason, what do you think about an RSP gross up loan as a way to boost your retirement savings over the long term?
Yeah, good question. I've written about this in the past, I think, for Money Sense, and certainly done a lot of interviews over the years. And I think there's no right or wrong way. I shouldn't say that. There's no one right way or no wrong way to manage your finances. I think everyone's entitled to different opinions, but I don't love the concept, and this is why. For most people, if they contribute to an RRSP, they're going to get a tax refund of between 20% and 50%. So let's say it's 35% on average. So if you borrow money on an RSP loan, you make a contribution, you're going to get back, say, 35%. You've still got 65% of the loan to repay. And if you can't find the cash in the first place to make additional RSP contributions, I think it might be hard to find the cash flow to make those loan payments for the balance of the year. And there could be an exception, I think, if you've got, say, a really high income year and you're really trying to take advantage of an RSP contribution in that year. Or say you've got a liquidity event coming, you've got a bonus, you've got, you're selling real estate, you've got an inheritance, something else where you're going to be able to pay off the loan from some other source. I just think if you're going to find the cash flow to make the loan payments, you might as well just start contributing monthly to your RSP for the next year to get a head start, right? I think that moving forward the RSP deduction by 1 year by taking the loan is not going to be a game changer for most people, again, unless it's like a really extraordinary income year. And frankly, most people in Canada have too much debt as it is. And I find that most clients I work with don't borrow money to invest. And unfortunately, I find that people who tend to borrow money to invest are the wrong people. So proceed with caution, particularly if a financial advisor is encouraging you to borrow money to invest. It might be more in their best interest than your own.
I guess so. Moral of the story: there's no one-size-fits-all answer really to anything, but especially when we're talking about retirement planning and investment portfolio planning. But then also a little forethought throughout the entire year. Those little acts and contributions go off to make a big impact. Also, you triggered a thought for me as well. You mentioned your articles you've written in the past. Give you a little plug there as well. On the left-hand side, we've got a link to Jason's articles he's written for Money Sense. There's also a link over there to the Objective Financial Partners website and to Jason's social handles. So go ahead and give that a check out so you can follow up on some of the other great insight that he's been able to contribute. All right, we've got one more clip here. Our next idea comes from dividend investor and blogger Henry Ma. He offered a way for early retirees to pay little to no tax that first stretch of their golden years by investing heavily in Canadian dividend stocks and taking advantage of the dividend tax credit.
If you don't have any other income, no CPP, no interest, no RIF withdrawals, no RSP withdrawals, no rental income, right? It just has to be dividend income only. For Alberta, you can earn almost $58,000 and pay no income tax at all. I would suggest that if you have an RRSP, that you delay Canada Pension, CPP as long as possible, but withdraw your RRSP dollars, even if you deplete it before you reach 65 or 70. Well, then you could switch to your non-registered account and withdraw the dividends. And if that's the only source of income that you have, then, like I say, you could go up to the 50,000, 55,000 of dividend income as your, main means of support until you want to collect CPP and OAS.
All right, Jason, what do you think about this strategy, depleting your RSP, which you kind of talked about a little bit earlier, and then using that dividend tax credit to drastically reduce taxes in early stages of retirement?
Yeah, there's a lot of different ideas in there. So again, everyone's entitled to their own opinion. I have my own opinions, which I'll share here. So dividend tax credit is a way that Canadian dividends are taxed at a lower tax rate than other sources of income. I think that focusing too much on Canadian dividends can lead to a situation where somebody has an inefficient investment portfolio. But it is true, if you've got primarily Canadian dividend income, you can pay no tax. Interestingly, at some levels of income in some provinces, you can even have negative tax, believe it or not, where you actually save tax by earning dividend income. Not super common, but I think there's three reasons that I would be cautious about the strategy. One, I sort of alluded to it earlier, Canadian dividend stocks, super poorly diversified, mainly banks, energy companies, telecoms, utilities, REITs, which make up maybe a quarter of the S&P 500. And I think a great example that I know I was looking at the other day, Bell Canada, I think is down like 30% over the past year, whereas the Toronto Stock Exchange and the S&P 500 are up like 30%. Pays an 11% dividend right now, but you underperformed North American equities by 60%, focusing on that dividend stock. I think the second thing I'd be careful about is dividends are the after-tax profits of a corporation that the board of directors has said, look, we don't have anything better to do with it. Let's just give it to investors. And if they don't reinvest in growing the business, you're probably going to see less capital growth from that investment. Like dividend stocks, dividends are not free money. And capital gains, frankly, are taxable at a favorable rate. They can be deferred and controlled a lot better than dividends that go on your tax return every year. And there was a reference to drawing down and getting rid of your RSP, which again, I just talked about early RSP withdrawals, but I think fully depleting your RSP so you can live off dividends there might be situations where that makes sense, but I think you got to be careful about it. You need to look at your personal situation. The concept of deferring CPP, definitely like that very much, and I think it's overlooked by retirees. But I think the main comment is that it depends. Canadian dividends are not magical, may or may not work for you, but definitely not a universal strategy that I would say everybody should be trying to do this.
Now, I don't know what this says about me, but when you said there were certain circumstances that could have negative tax, my mind went to that show around where there's extreme coupon clipping, where people were, getting very low grocery bills because of these stacks and stacks of coupons they had. And, yes, it worked for them in that moment, but at what cost, right? In the broader scheme of things. So, yeah, like you said, it's that famous answer. It depends. It could work in the moment, but you need to evaluate your own situation. So,
for sure.
All right, we're gonna have to leave the interview portion of our conversation there, but we're not done yet. We're gonna open the floor to questions from our viewers. You ready to hear what our audience wants to know more about, Jason?
Sorry, I missed that.
All right. Oh, we're ready for the Q&A. You game to take some questions?
Sounds good.
All right, let's do it. Our first question is coming to us from Me. Me wants to know if we have Canadian or U.S. mutual funds in a RIF account, is there withholding tax on that?
So it depends. The investments themselves, if it's a Canadian equity mutual fund, there's no withholding tax within the RIF account. If it's a Canadian equity mutual fund, a Canadian mutual fund, you can't own a U.S. mutual fund in a RIF. You can own a Canadian mutual fund that's in Canada that owns U.S. stocks. There would be withholding tax on the U.S. stocks before they hit the mutual fund. So you're going to lose part of your return on U.S. stocks that you own through a mutual fund within a RIF. And then what you do beyond that, if you take withdrawals from the RIF, there's tax implications on that income. But the investments themselves, U.S. stocks owned in a Canadian mutual fund would have withholding tax before it hit the account. So you can own U.S. stocks directly and avoid withholding tax on the dividends. But if you own through a mutual fund or ETF, there would be withholding tax before it even arrives in the fund itself.
Yeah, good point. Sometimes it's worth kind of peeling back the onion and looking at the different layers, looking at the prospectus on the mutual fund, just really to make sure that it's suitable for your particular application of the fund. All right, next question. This one comes to us from Nelson. Nelson's got a question. He wants to know, how does your contribution room reclaiming work for TFSA? And he's got an example here. He puts in $6,000, which would be his maximum amount, and it grows to $7,000. If I withdraw the full $7,000, am I then able to recontribute that full $7,000 the following year?
That is correct. So whatever you take out of the TFSA gets added back to your TFSA room. It's the amount of the withdrawal, nothing to do with how much you originally contributed, nothing to do with how much the investment originally cost. Every dollar you pull out of your TFSA gets added back to your TFSA room the next year.
Kind of maybe a general follow-up question to that. There's always from speaking to clients, in years gone by, there's always seems to be this kind of boogeyman thought around, well, what if the CRA deems that this is like income, or that I've taken too much profit from my TFSAs, that they might remove like the tax-free nature of the account. How do you kind of speak to that?
So that's a good question. I mean, there's a couple things that come to mind. One is that if you are day trading in your TFSA and you are frequently buying and selling investments, there's actually a risk that your profits, which would otherwise be tax-free, could become taxable as business income. Day trading or frequent trading in your TFSA, it's not like it's a clear answer that if you do more than this number of trades per month or year, it becomes business income. But it is something to be careful about if you're doing a lot of buying and selling in your TFSA. The other thing that comes to mind is I know there was speculation at one point in the UK, there's something similar to a TFSA called an ISA, investment savings account. I know when they were first introduced, the intention, I believe, was to have a lifetime limit. And I know that's something that's been tossed around a little bit, that at some point you put a cap on TFSA contribution room. And at least as it stands right now, the intention is to continue to allow Canadians to accrue TFSA room. But is there a point that comes where there's only so much you can put in your TFSA? Anything could happen.
Yeah, you wonder where that taxable income stream, if that starts to be depleted, because unlike the RSP, like you mentioned earlier, it's not tax-free, it's just deferred. And ideally, the government, from their perspective, they're taxing you now when you've got a bigger, pot of pie, or pot that you're sitting on, as opposed to the TFSA where the tax revenue is gone. So, okay, great answer. Thanks for that clarification as well. Next question comes to us from G. They want to know, what's the procedure to convert stocks from a RIF account to a TFSA?
So good question, and really there's two components to it. When you have a RIF, a registered retirement income fund, there's a minimum withdrawal that you have to take every year, but there's no maximum withdrawal. You can take out any amount that you want, keeping in mind it is fully taxable income, so proceed with caution. But when you take a withdrawal from a RIF, it can be done in cash, or it can be done what they call in kind. And an in-kind withdrawal from a RIF, or an RSP for that matter, is when you transfer investments out of the account. That withdrawal would be subject to withholding tax, it would be subject to income tax, so it would be just like taking cash out. There's no magic to transferring the investment in kind out. And then the second part of that transaction would be a TFSA contribution. And there's no opportunity to transfer directly from a RIF to a TFSA that allows you to avoid tax on the RIF withdrawal, or allows you to put in extra money or anything like that. If you then contribute or transfer the investment into a TFSA, you need to have TFSA room, and it would be just like putting in cash. So I think the benefit is not having to sell the investment, but you might have pretty modest transaction costs just to sell and then transfer the cash out and buy in your TFSA.
Yeah, that's very well described. And there's a number of steps along the way in that process, but rest assured, Our folks in our contact centers are well prepared to help you with those transactions if and when that applies to you. Hey, Jason, I had a quick follow-up around, RIF accounts kind of while we're on the topic. Some clients or some investors have locked-in RIFs, right? So when they convert when you're able to do your conversion of your RIF, those RIFs have kind of minimums you're required to take out, but they've got maximums that you're required to that you can take out. So you're limited on an annual basis. Is there a situation where at conversion it might make sense for you to take a lump sum that may be allowable, when you're doing those conversions for those types of individuals?
For sure, yeah. So if you've taken money from a pension plan, whether it's a defined contribution pension plan or you've received a lump sum from a defined benefit pension plan, that money goes into a locked-in RSP, a locked-in retirement account. And the locked-in part means you can't take withdrawals typically before age 55, and there are maximum annual withdrawals that you can take. And depending on the province where the pension was housed, there are different restrictions on unlocking a locked-in retirement account. But in many provinces, when you convert your locked-in retirement account to a LIF, a life income fund, which is kind of like the locked-in version of a RIF account, you can withdraw up to 50%. And that withdrawal can be literally a withdrawal that you take into income, or it can be transferred on a tax-deferred basis into a RIF, a non-locked-in account. And there may never be an advantage to unlocking 50% of your locked-in account. You may never take more than the minimum withdrawals, for example. But I think it's something that I would do to enable more flexibility with your money in the future. So take a look, depending on the province you're in, you may be able to unlock an account as you convert it to the LIF or withdrawal version of the locked-in account.
All right, just some more food for thought. Thanks for that. Next question. It comes to us from Charlotte. She's got a bit of a scenario that she'd like to get your perspective on. She's saying, I have 3 years till retirement. Is it worth contributing to a spousal RSP? She's still working. Her husband's retired already. Wondering about 3 years worth of attribution. Or attribution rule, as she's put it.
Yeah, maybe. So quick background, a spousal RSP is an account that you contribute to, but your spouse owns. So you get the tax deduction. It's based on your RSP room, and the withdrawals are taken by your spouse who owns the account. And up until about 15 or 16 or 17 years ago, it was really the only way to split income from a higher income spouse to a lower income spouse with RSPs. Now, since I think 2007, you're allowed to split up to 50% of your RIF withdrawals after the age of 65. So spousal RSPs have become less common, less popular, less used, let's say. But I think there could be an opportunity potentially to take advantage of a spousal RSP, whether it's 1 year or whether it's 30 years that you're contributing. But if you're relatively close to age 65 and you're going to be converting your RSP to a RIF anyways, again, you can move up to 50% of your withdrawals to your spouse. Now that rule could change in the future, and that's one reason contributing to a spousal RSP protects your income splitting opportunities. But the one caveat, I don't know if this is what she was referring to on the 3-year rule, if you contribute to a spousal RSP and your spouse withdraws from it within 3 years, that income, that withdrawal gets attributed back to you. There's spousal attribution of that income, and it goes back on your tax return, which is not the intention. But spousal RSPs have a place, consider them, but also take into account your ability to split RIF withdrawals after age 65.
Yeah, it's nice to know you've got some flexibility. You're not just pigeonholed into that. The income splitting it seems to be much easier than it has been in the past. All right, last question here for you, Jason. I've heard some investors. This one's actually coming to us from Matt. Don't want to make sure Matt gets the credit for his question here. I've heard some investors will intentionally over-contribute to their TFSAs in hopes of earning a greater return than the 1% penalty per month they would pay on over contributions. What would the potential downsides of this be?
I think the downside to me is not earning a 1% monthly return on your TFSA. I mean, that's 12% plus, really, that you would need to earn on your TFSA to offset the penalties. I think that's unlikely that it's going to happen over the long run, and the TFSA over contribution penalties are done that way intentionally, so that it's probably a losing proposition. I know that it's been a great year for stocks, and I know that some investors have a lot of confidence in their abilities, but I would say that it's not a strategy I would pursue. I think it's more likely that you would come out worse off for having over-contributed to your TFSA.
All right. Thank you so much for taking the time, Jason. I know I've learned a lot. I'm sure the audience has well, but we're gonna have to leave it there. Do you have any final thoughts you'd like to share with the viewers?
Yeah, look, I alluded to this earlier, Jason, that you know, you can only spend your after-tax returns or income or whatever. So I think that's really what matters. Tax is important, and I think that people generally deal with it retroactively when they do their tax returns. So try to deal with it proactively. If you've got an accountant, ask them for tax advice. Not a lot of people do that, and I think it's a missed opportunity. If you've got a financial advisor, you know, hopefully they're doing more for you than just managing your investments, because that's becoming much more of a commodity, you know. So seek out advice on tax planning, retirement planning, whether it's them or somebody on their team. And if you're self-directed, as I think that most people listening in are, you got to do the stuff on your own. You know, so take the time to understand the tax implications of your income and your investments, so you can keep more of what you earn.
All right, well said. Thanks so much. And thank you again for joining us. And for those in our audience, you can make sure to register for some of our upcoming live webinars. You can check out, and by the way, the links are below at the bottom of the screen. You can see the links. This is our last webinar for the year, but come join us January 9th. We're getting right back on the air, so we'd love to see you in those events. But don't fret, if you're not able to join us for a live, they are available on demand, and that's available in our Learning Center as well as on our YouTube page. With that being said, we'll see you all next time. Have more questions? Check out the links to the right and in the description below.